investors, including private equity, have deployed nearly $6 billion into distressed companies so far this year, the highest volume since 2008. But these deals do come at a cost, in some cases diluting existing stakeholders and pushing for board representation. To discuss more about how these deals are constructed, let's bring in the co-president and founding partner of Moelis Company, Navid Mahmoodzadegan. Navid, it's good to have you on. How should investors read into the surge in PIPE deals?
Well, thank you, Seema. Thank you, Kelly, for having me on today. Well, look, sponsor PIPEs are really kind of tailor-made for the current environment. What they do is they provide companies that are looking for extra liquidity, extra capital, with three things. First, certainty on terms, which is incredibly important in a volatile market like we have today. Two, customization. And so the ability to sit down and negotiate a highly customized instrument that works for both the company and the investor in size is incredibly important. And three, sponsorship. One of the things that you mentioned earlier, board representation, there are companies that are looking for, that vote of confidence, and having a blue chip, smart money, private equity firm invest in those companies certainly provides that. I think one of the things you've seen with many of these PIPEs that have been announced over the last few weeks is very positive stock price performance in the issuing company post-announcement.
Yeah, the stock reaction, of course, has been positive following that deal with Expedia, Apollo Global, and Silver Lake Partners, putting over $1 billion to work into that online travel company. But there are some critics who say, Navid, that these type of deals invite predatory behavior on behalf of the private equity firms. What would you say to that?
No, usually with these transactions, there's a highly negotiated set of terms where there's limits to what any new investor can do in terms of influence at these companies, and the vast majority of these situations, these are private equity firms that are looking to be constructive. They're looking to add value to these companies through their board representation, and there's very little risk in the PIPEs we've seen over the last number of weeks in terms of anything like predatory behavior. I think one of the things that's important and useful to talk about is, private equity is often, the whipping boy in the media these days about all of society's economic ills. I think this is a really good example where private equity is providing a real support to companies, a real benefit to the capital markets in terms of providing capital quickly, on terms that are advantageous from a company perspective, and providing a real service to our economy and to companies that are looking for capital.
Navid, the show's about to end, so I'm going to try to squeeze this in. But can you give us a few examples of successful PIPE deals from the last time around, so people can look at how this would work out well instead of how it would, pile up more debt on companies or be a hindrance in the longer run?
Well, sure. Like the classic set of examples of PIPE deals were the Berkshire deals in the financial crisis, right? With all of the financial services companies. And so I think, those transactions were done at a moment where people were looking for confidence. They were looking for somebody to stand up and say, I believe in these companies. And I think you're seeing a similar thing happen right now. Most of these deals are being done with world-class companies, with world-class management teams like Expedia. And these will be industry leaders and will be very profitable companies when the market recovers.
All right, Navid Mahmoodzadegan, you should ask interview candidates how to pronounce that as a screener. Thank you very much for joining us today. Seema, really appreciate it as well.